that this is not going to be the geopolitical uncertainty will settle down in the near term. With that perspective, I don't think so. There will be significant change in the monetary policy stance.
And what would your messaging be to the investors in terms of how they should be looking at positioning? Hello, investors. Welcome to Moneynomics by Axis Mutual Fund. I'm Shalini Gautam, and I have with me our head of fixed income, Devang Shah. Today, Devang will talk to us about his views on how the geopolitical conflicts will play on the Indian economy and the global economy. How will growth and inflation play out? What will RBI do in these uncertain times? And what should investors watch for? So, Devang, let's begin with the fact that geopolitical conflict is the key discussion happening these days. Everyone is watching it pretty keenly. How do you see this conflict playing out in terms of crude? How will it impact inflation and growth globally and in India?
Sure, Shadi. So, as you rightly highlighted, I think in the last 1 month, post policy and post the budget, markets have been very sideways on fixed income, and we have guided that probably in this year we will not see too much of actions from RBI. All of a sudden we had this event, and it's unforeseen to have such kind of geopolitical events, but the impact has been largely, if you ask me, has been on crude prices, and it's definitely significantly higher, because if you look at the crude prices have gone up from less than 60 when I'm talking about Brent, and it touched momentarily a couple of days back around $115. So it's largely a 60, 70, 80% upside in move, which is very not very positive for an economy like India, where we have a lot of imports on crude. I think 80% of our oil imports are imported, and somewhere down the line, the second perspective is a large part of it passes through the Strait of Hormuz, which is somewhere down the line at this point of time not functioning efficiently. In this context, we have seen a lot of volatility across asset classes. Fixed income also has been a party to it for some point of time. But to be fair, if I look across that, and if we look across the impact of this on bond markets, the bond market impact has been very, very muted. Their overall playbook from a central banker in such kind of environment where you are seeing widening of current account deficit due to crude imports, you can see an impact on inflation. The original textbook approach would have been liquidity tightness, and somewhere down the line the expectation and fears of rate hikes. But the general assumption today is that probably this is not going to last for long. So the overall perspective is that yes, there is a geopolitical uncertainty, but somewhere down the line this should end soon. And markets are somewhere down the line, I think, probably pricing in a near-term closure rather than having crude prices elevated or stay elevated for a longer point of time. If you look, there have been a lot of measures also. OPEC has talked about increase in oil prices supply. So we believe that once the geopolitical this settle down, I think the overall macro environment on specifically on fixed income would continue with the same perspective, which is lower inflation, and somewhere down the line the growth would continue to remain around close to 6.5-7%. But you have a valid question that there can be a small probability that this continues for a longer point of time. In fact, during Ukraine-Russia war also, all of us anticipated the war would get close sooner, but it's been more than 2-3 years and the war has continued. So if such a scenario boils down, then we are going to see significant headwinds for the economy like India, which has been got a lot of macro positives over the last 2-3 years. We will have problems on current account deficit because the current account deficit will widen by more than 0.5, 0.6. So we are close to 1.2, 1.3% on current account deficit, could go to close to 2% for the next year. Second, if somewhere down the line oil prices continues at 100, I think inflation will see a significant rise. We are talking about inflation settling for the year at close to 4.5%. Inflation will go above 5%, and 5 to 5.5 would be the band for inflation if crude prices continue from a medium term perspective. Lastly, I think the bigger risk would be on growth cycle in India, and growth will start seeing shave off because certain sectors, certain industries, once oil starts hitting $100, you will see a lot of impact on certain sectors, somewhere down the line, certain industries, employment, even consumption cycle. So all of these will lead to significant markdown on growth projections, where we are all projecting 6.5-7% growth, probably will be significant lower of growth. So that's not a view at Axis or the fixed income side that this will continue for long. But if this continues for long, there will be significant, I would say, impact on Indian economy.
Okay. Having said that, we were in a better shape in terms of controlled inflation lower rates. In fact, we were expecting lower for longer environment. Now, do you see, because of this, the RBI making any changes in terms of liquidity measures, or do you see any environment of rate hikes going forward?
So again, I will say that the base view continues with the fact that this is not going to be the geopolitical uncertainty will settle down in the near term. With that perspective, I don't think so. There will be significant change in the monetary policy stance because we believe that they will look at from a medium term perspective. They settles down, crude will again fall below, or Brent prices will fall below $70. With that context, we don't see any significant policy movement changes. To somewhere online address the near term volatility, RBI again has been very, very proactive. So you asked the question that we have not seen too much of volatility on bond markets. Why so? It is important to understand that despite there is a lot of volatility in currency, RBI has been intervening in the FX market, and RBI has done an intervention of more than 20 billion in the last, I would say, few days and few sessions. And correspondingly, RBI has also ensured to infuse the same amount of liquidity into the system. And that is why we are actually seeing bond yields not flying anywhere. We have seen bond yields to remain quite stable. Today also, I think pre this entire geopolitical conflict started, 10-year bond yields were hovering around close to 665. Today also their bond yields are closer to 665, 670. Swap yields, the OIS side, has seen some uptick, but I think probably they will also somewhere down the line start trading in a range. So our view is RBI has been very, very proactive, and if this ends in a shorter span of time, I don't see any change in the monetary policy course, and we expect rates to remain lower for longer. If the eventually plays out, which is less than 5-10% probability for us, and if this war continues for a longer point of time, I think there is a very, very high possibility that markets will start pricing in rate hikes in the second half of the year, and which can probably lead to sell-off and bond market yields to the tune of around 25 to 50 odd basis.
So you have been following a accrual and a tactical duration approach. Does that approach change at all? And what would your messaging be to the investors in terms of how they should be looking at the positioning?
So, rightly pointed out, Shani, that we have been of the view that this year we will not see significant changes in bond markets, and we believe that monetary policy stance will also continue to remain the same for most part of the year. There will be not significant rate hikes nor rate cuts. With that context, what we advise client was is in the year you have to probably build in accrual as a strategy with significantly lower duration, and there might be some tactical opportunities to enter long funds because of Bloomberg inclusion, because of HDL spreads widening. So all of these trades might play out, but larger concentration should be lower duration as well as accrual as the theme. In fact, with this kind of volatility, thanks to the geopolitical volatility, I would say we rehash the same perspective, and we believe that our case for accrual and lower duration becomes much more stronger. In these uncertain times, in this volatile period, I think to build on a carry and build in those short duration funds significantly ensure a 12-18 month good return, whether through this volatility. I think we continue to focus on in our portfolios to build in accrual and low duration portfolios. We will be using these tactical trades and opportunities which markets will provide us to build in some duration at an opportune time. But today, if you'll ask me, we have not made any significant changes. We continue to advise clients to stay at the short end of the curve, 1 to 2 year segment, and somewhere down the line focus as accrual as the theme, and probably tactically use gilt funds for opportunities as and when they arise.
Thank you so much for your views, Devang. And thank you to all our investors. Stay invested.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.